Every time the stock market crashes, you hear the same headline: trillions of dollars wiped out in a single day. Your portfolio is down, the charts are red, and it feels like wealth is being destroyed in real time. But here's the uncomfortable question most people never stop to ask. Where did that money actually go? Did it disappear? Did someone take it? Or was it never really there in the first place? Because the truth is, when the market falls, money doesn't just evaporate, and understanding this changes the way you see crashes forever. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer: this is not financial advice. To figure out where the money goes, we have to stop thinking about the stock market like a bank vault and start thinking about it like a giant, high-speed pawn shop. When a headline says, "The market lost $2 trillion, it doesn't mean someone logged into a central bank and withdrew $2 trillion in cash. It means the price of stocks fell. When you multiply all those lower prices by the total number of shares, the total value is now lower. Think of it like your house. Let's say last year, a realtor told you your house was worth $500,000. It felt great and you felt rich. But this year, the market cools down and a new realtor says, "Hey, it's probably worth $450,000 now." Did $50,000 in cash physically leave your bank account? Of course not. Nothing moved. The only thing that changed was the price someone is willing to pay right now. Stocks are the same. The market is just an auction. If a company has 10 million shares and the price drops from $100 to $80, we say the market lost $200 million. But no one pulled $200 million out of the system. All that happened is that the crowd got scared and decided the item up for auction wasn't worth as much today. So if the money isn't just vanishing, who actually gets hurt when the market crashes? The answer is simple. You only truly lose money if you sell. Imagine you bought a stock at $100. The market crashes and it's now at $50. You look at your account and see you're down 50%. That hurts, but that's a paper loss. You haven't lost a dime of real usable cash yet. You still own the stock. Now, let's say you panic. You see the news, you get scared, and you sell at $50. In that instant, your paper loss becomes a real loss. You just turned $100 into $50. You locked it in. The money is gone from your pocket. But here's the part the headlines ignore. For you to sell that stock at $50, someone had to buy it from you at $50. While you were panicking and hitting the sell button, another person, maybe a pension fund, maybe a savvy investor who's been waiting for this moment, hit the buy button. They just bought a stock for $50 that was worth $100 a few months ago. They think it's on sale. This is the real story of a market crash. It's a giant, chaotic wealth transfer machine. Think of the entire stock market as a room full of people. Suddenly someone yells, "Fire!" That's the bad news. Everyone panics and rushes for the only exit, throwing their valuable jackets, which would be the stocks, on the floor as they run. The people who get hurt are the ones who panic and throw away their jackets. The people who win? They are the ones who are standing near the exit, calm, with empty hands and deep pockets. They simply bend down, pick up the jackets for free, and walk out calmly. Of course, in real life, picking up stocks when everyone's panicking isn't this simple. You never know if the market will recover or how long it might take. Investing always carries risk, so staying calm and doing your research is very important. During a crash, money rotates. It flows out of risky assets like stocks and flows into things that feel safer in the moment. It flows into cash. It flows into government bonds. It might even flow into tangible stuff like gold, which people trust when they don't trust the financial system. So that money you thought was destroyed? It's just sitting on the sidelines in a money market account, waiting for the panic to end, waiting to be deployed back into the market to buy those stocks at an even lower price. Okay, but if the money is just rotating, why do crashes feel so violent and destructive? That's because of a mechanism called forced selling. This is where the paper loss can become a real loss, even for people who don't want to sell. This mainly affects big institutions and over-leveraged traders. people who borrowed money to buy stocks. Let's say a hedge fund bought $1 billion worth of stock, but they only used $100 million of their own money. They borrowed the rest. If the stock drops too much, the bank that lent them the money gets nervous. The bank says, "Your collateral is shrinking. You need to give us more cash, or we will sell your stocks to get our money back." This is a margin call. The fund doesn't want to sell, but they have to. This forced selling drives the price down even more, which triggers margin calls for other funds, which leads to more forced selling. It's a domino effect, and it creates a terrifying spiral. During this chaos, liquidity dries up. It becomes hard to find a buyer. This is the moment when it genuinely feels like money is disappearing because the selling is so one-sided. But it's not that the money is gone, it's that the buyers are hiding. They're waiting for the spiral to stop. Let's look at the 2008 financial crisis. When Lehman Brothers collapsed, it was the ultimate fire moment. The S&P 500 plummeted. Headlines screamed about trillions lost. Homeowners were forced to sell, and big banks were forced to sell. If you were a regular person with an index fund and you checked your balance in March of 2009, it probably looked decimated. You had a massive paper loss. If you panicked and sold everything then, you locked in that loss. You gave your stocks to someone else at the worst possible moment. But who was on the other side of that trade? Who was buying in March of 2009? It was the people who understood this concept. It was institutional investors who had raised cash. It was everyday investors who kept their jobs, kept their nerve, and kept contributing to their portfolios. They were buying the jackets that everyone else had thrown on the floor. If you bought the S&P 500 in March 2009, you weren't just recovering your losses. You were setting yourself up for one of the greatest bull markets in history. The money wasn't destroyed in 2008, it was simply handed over from the panic sellers of 2008 to the patient buyers of 2009. So, here's the takeaway that most people miss, and it's the only thing you need to remember. Stop checking your portfolio value every day. That number is just today's auction price. It's not your bank balance. It's a paper loss or a paper gain. The only thing you can control is whether you are a panic seller or a patient buyer. When the next crash comes, and it will, and you see those terrifying headlines, ask yourself, do I have cash? Can I afford to do nothing? If the answer is yes, then the scariest moment in the market might just become your best opportunity. And that's all for today. If you enjoyed the video, please like and subscribe to continue growing this community. Thanks for watching, and see you very soon. Bye.